Hey guys, it's me, 𝗦𝗚𝗎𝗍𝗍, and this week I'm going to be talking about a new stock in my portfolio, Evolution AB. As I've just said, I hold shares in Evo, so I am biased. This video is not financial advice and should not be taken as such, and when you make your own investments, please make sure you do so at your own risk and do your own research and come to your own conclusions. So with that said, let's get into the 5 reasons I like this stock that is beating even Nvidia in earnings growth. The number 1 reason that I like this stock is going to be no surprise, and that is growth. But its growth isn't just big, it's humongous. About 10 years ago, it's making 7 million euros, and today it's making over 1 billion euros. To put this into context, this is over double the growth of Nvidia across the same time period. But to be honest, I want to get into why Evolution AB's growth is better than Nvidia's growth. Since 2022, Nvidia's earnings have gone from around $9 billion, I believe, to 30 billion. But measuring growth on short time frames like this is super misleading for investors. Here's why. If I bought a plot of land 5 years ago for 100k and then did work on the land and built a hotel on it for 200k and then sold the hotel 5 years after buying the land for 500k, this investment would have made me no money for 5 years and then suddenly, overnight, made me 500k. On my balance sheet in a single year, I have 500k of revenue from 0 the previous year. What we know in reality though is actually it's taken me 5 years to make 500k, and 500k minus all the costs, the expenditures across those 5 years, it's actually made me 200k. 200k divided by 5 years is 40k a year. So it doesn't just matter that Nvidia went from 9 billion in earnings to 29 billion or 30 billion in earnings. It really matters when they began investing in AI to begin with, and they began investing in AI in 2006. So to continue this analogy that it took 5 years to build this house, it took 18 years for Nvidia to build AI. Suddenly, this 20 to 30 billion that they've made seemingly out of the blue looks a lot less impressive when you stretch it over the entirety of the time period it took to generate the facilities and technology that ultimately led to this revenue. So even though when I look at Nvidia, while I see an incredible business, when I see another business that got more growth just over a longer time period, it didn't just achieve all this growth in the last 2 years, that is actually an advantage to me. I would obviously prefer a company to grow steadily, consistently each year than all of a sudden, out of the blue, in 2 years every decade. Now, the next reason I like this business is its moat. If you didn't know already, Evo AB is a gambling business. It provides technology, software, casino tables for online casinos and games. And so what this does is, for investors, this puts it in a similar investing category as oil and cigarettes. Essentially, these stocks are permanently cheap, which will impact the capital gain slowly. But on the plus side, being permanently cheap means that we can buy back more shares, more equity in the business, and we get better dividend yields on the stocks. So we do actually get better capital gains appreciation thanks to the fact that our earnings per share can go up more easily. Also, being in an industry which people are hesitant towards investing in massively reduces your risk of competition. Think how many people right now are chasing Nvidia's 30 billion in earnings or their $3.2 trillion market cap. Right now, there are going to be 1,000 factories in Taiwan with almost unlimited funding trying to replicate Nvidia's success. On top of this, every intern and engineer at Nvidia is going to be getting pay packages offered to them through the roof to come move and work to other companies, and Nvidia's got to keep up with that competition. By comparison to a company like Nvidia, Evolution AB has almost no competition. In fact, even in the gambling industry, they have made themselves indispensable due to an ingenious decision made about a decade ago. Instead of being in the profitable but volatile casino business, they are in the business of selling the actual games themselves, leasing them to the casinos. They lease the actual technology behind the games on sites like 𝗦𝗡𝗡𝗡, William Hill, and Paddy Power. However, they do also still to this day build actual casino tables for actual casinos, or perhaps it's for the visuals online, and they do repairs on those tables as well because they've got their own warehouse, and because they've got their own warehouse, they are able to keep control of the quality. And this is what it comes down to, is control over quality. For me, Evolution AB is very similar to McDonald's. If you've ever watched the film The Founder, if you haven't watched it, go watch it now, but it follows the story of Ray Kroc founding the McDonald's empire. There's a great scene where an accountant finds Ray and explains to him that he shouldn't be in the burger business, he should be in the real estate business. Once McDonald's switched from taking profits from franchisees to owning the land of which the property sat on, they gained far more control over the franchisees and managed to keep a much more consistent quality across all their shops. Ultimately, this led McDonald's to being far more profitable because it became a recognized brand for quality. But what it also did for McDonald's was it gave a much more steady supply of income, and that enabled them to borrow even more money, buy more land, and build more properties. It also helped that back then land was super crazy cheap. But yeah, this is the real power behind Evolution AB. They don't run the casinos, they lease the technology and the software in order to run casinos. And it must be pretty brilliant because basically all online casinos use their software and pay through the roof for it. And it's easy to understand why which independent casino is really going to invest all the money and infrastructure in order to develop this. It makes far more sense for them all to share the software and technology and simply pay Evolution AB for the best version of this technology. But what this means for Evolution AB is that they have quality, reliable income sources and control over who they lease their product to. Essentially, the way that I look at it is that Evolution AB owns the land that these casinos sit on. Except for Evolution AB, they don't need any expensive land for their casinos to sit on. This is the internet. Their land is technology and software. It's unlikely we'll see any competition soon, unlike our slow-growing Nvidia that has tons of competition. This leads me nicely onto reason number 3, and that is its dividend. Currently, its dividend yield is just over 2% and is easily covered by cash flow. But that's not the reason I like its dividend. The reason I like its dividend is because of dividend growth. And this is an important lesson to people because a lot of people do not think to look at dividend growth, and it's almost as important as the dividend yield. The 5-year compound annual growth rate on this stock's dividend is 60%. To be clear, this is absolutely insane, but let's put it into numbers. This means that if you invest £100 into this stock, this year you'll get a £2 dividend. Not very impressive. But in 5 years' time, this stock will be giving you a £21 dividend without reinvesting any of the money. The formula for this is really simple. You take the £2 dividend and you times it by 1.6, which is the decimal version of 60%, to the power of 5 years. And voila, here you have it, £21 a year. Now, if history continues to repeat itself and it does achieve this, it's more than likely that this £21 dividend will be a 2% yield on the stock. Now, for £21 to be a 2% yield, the share price of this stock would need to be £1,000. This is how, even if we grow half as much as we did over the last 10-year period into the next 5-year period, in 5 years' time, you'll have gone from having £100 of shares to having £500 of shares, paying £10 a year, which is 10% of what you originally invested. Now, this leads me on to point number 4, which is one of the biggest reasons I love this stock, and that is its margin. As you can imagine, all this technology for online casinos, building these elaborate online casino software and technology is incredibly expensive. However, the great thing is once you've built this for one casino, building it for other casinos is not very expensive at all. What that means is growing the business is extremely cheap, and every time you do, your revenue goes up, but your costs stay relatively the same. That is why over the last 10 years, Evo has gone from having a 20% margin to a 60% margin. In fact, because they license all their technology, they have practically no costs to speak of. Their costs of sales is zero. And because there is so little competition and the product never changes, there's no expense for research and development. Their entire expenses for their 1.7 billion in revenue is just 700 million. That means their revenue could drop by half, their expenses not change, and they'd still have money to do a dividend. Okay, finally, let's talk about the most important reason, the thing that separates Evo from stocks like Nvidia the most, is its price to earnings. Evo has a price to earnings of 19, which does indicate growth, but given how much growth this stock has had and how much potential growth I think there is, I think this price to earnings of 19 is a huge understatement. It would be really hard for a company with margins this large and growth this big to not hit this expectation. So for fun, because we're using a casino stock, let's use a casino analogy to point out the absurdity of Nvidia's price next to Evo's. In this casino, there is one game, and it is very, very simple. You roll a dice, and if you hit 6, you double your money. In the first roll of the dice, the odds of losing are 83%. But now imagine you get the chance to roll 6 times. Well, then your odds of losing drop to 33%. Now imagine you get to roll the dice 18 times. Now your odds of losing drop to 3.7%. That means if you get to roll the dice 18 times, the chance of doubling your money goes up to 96%. If you had 100 rolls, the chances of never rolling a 6 are virtually zero, but there is always that chance. And people hate it, but luck is involved in all investing. The important thing to remember is that odds are involved too, and odds are way, way more important. When we are thinking and talking about the future, we can get as excited as we like about Tesla and Nvidia. But when we're talking about investing our money and increasing our chances of growing that money quickly, then we need to use odds. Investing in companies like Nvidia that have insane growth, but every man and his dog wants to buy them, is an easy way to reduce your chances of winning, because Nvidia is 3 times riskier than Evo and has less growth. And it's why, for me, betting on something like Evolution AB feels like I am gambling, but I have the odds significantly stacked in my favor. However, hands down, the thing that you need to remember if you want to be rich is